Paul, he is the
stakeholder liaison
for the IRS. And
yes.
Do you want this more interactive? Hey, we have a question, answer, ask
away.
Yeah. So he's here to help us. And
now answers are, we'll see what happens with the question, but ask away.
Okay. So I'm going to turn it over to Paul. Welcome, Paul, and let's get this rolling. And everybody online, welcome.
Thank you. And good morning, everyone. Welcome to the HR series. I'm excited to have been invited by Jessica to present today. Today's lesson is called Better Business Through Better Records. It's pretty self-explanatory. I do want to do a little bit of an icebreaker. And are there any small business owners in the presentation today? Okay, so with that being said, what is your business? What do you do?
So we're the Charlotte Area Chamber.
Right.
So we're a membership-based organization.
Right.
We have events like this, workshops to better understand how to run your business.
Right. But do you have a separate sole proprietorship, partnership, corporation?
I do also have. I'm a partnership with a company called Promotion.
Okay. All right. Anyone else?
An LLC. I have my own business as leadership
and coaching. Okay. Great. So the reason I asked is because obviously, you're enthusiastic about your business and you want it to grow, and we want to facilitate whatever we can do to help you with that. One of the major things that you have to consider when opening a business is keeping good records. And who in here thinks they keep good records? No, it's very important. No, it's
depends on what you tell me today.
I like that response. I don't know. Yes. No, it's we'll get into it. Good morning. We'll get into it, but there's a lot of reasons to have to maintain good records as you'll be reminded of throughout this presentation. So with that being said, we'll go ahead and talk about a few things. I do want to highlight a few updates with the IRS. If I can simply go to the next screen. Okay, so the Inflation Reduction Act was passed, I believe it was in 2022, and part of the Inflation Reduction Act talked a little bit about clean energy credits, whether they be residential energy credits, clean vehicle credits, and a plethora of other credits that as you know, credits are dollar for dollars. It's a very, very good thing to get a credit. However, the IRS does, they want to warn you that, you don't want to fall victim to some of these scams that are out here when buying these clean energy tax credit under the Inflation Reduction Act. Go to irs.gov/news, and, they'll give you a little bit more information about what to look for as far as scams and how to avoid them, or maybe even to report them. So that would be, good information. Especially, you never know, you may come across wanting to take one of these credits on you as on the return. So be mindful, because false claims, and that's what it would be if you're not eligible for these credits, they could lead to future compliance action by the IRS and repaying the credit plus penalties and interest. So we try to keep you away from those choppy waters. So, yes.
So if we are presented with a a scam,
Mhm.
and we don't know, how do we go to verify that? Do we contact the IRS and say this?
So again, a lot of the information about all of these credits that are on included in the Inflation Reduction Act are found right on irs.gov.
Okay, so
So if
go
somebody's
compare.
steering you to their website,
Okay.
be mindful of that. See, I would suggest verify what they're saying is true on irs.gov. I am the stakeholder liaison for Charlotte. Oh, by the way, my name is Paul Sadler. Yes, I am the stakeholder liaison here in North Carolina, covering Charlotte. I have a colleague in Fayetteville, North Carolina. His name is Bobby Graham. He's a superstar in this stakeholder liaison world, and hopefully, one of these days we'll get to do a joint kind of presentation. You'll get to meet him. You'll love him. But we cover the North Carolina, and we do presentations such as this and things like small business tax workshop, small tax tax forums, where it might be a roundtable discussion from different industries, government managers, all types of different sources to provide education outreach to the community. So that is our role, and that is what we do. So moving on here, again, misinformation is very prevalent in the social media world. So IRS just wants you to be mindful that just because somebody's giving you what sounds like good advice on social media doesn't mean that it is good advice. So just be mindful. You can verify anything someone's telling you on irs.gov. If it doesn't exist on irs.gov, it probably doesn't exist. Now, doesn't mean that you can't reach out to me. We have a research team. I don't have all the answers, but we do have a research team that we can get you clarification if you have an item that you need to be addressed. So, feel free that you have someone that you can contact if you have, questions, concerns, or anything like that. So just be mindful. Let's see. All right. So now we're going to talk about record keeping uses. So everyone in business must keep records, and keeping good records is very important to your business, and good records will help you in several ways. So some of the ways includes monitoring the progress of your business. You will need good records to monitor the progress of your business. These records can show whether the business is improving, which items are selling, or what changes you need to make. Good records can increase the likelihood of business's success. You also need good records when you prepare your financial statements. You need good records to prepare financial statements, which include income statements for profit and loss and balance sheets. These statements can help you in dealing with the banks or creditors, and even help you manage your business. The income statement shows you income and expenses of the business for a given period of time, and the balance sheet shows assets, liabilities, and your equity in the business on a given date. You must be able to identify the source of any receipts. When you receive money or property from many sources, your records can identify the source of your receipts. You need this information to separate business from non-business receipts and taxable from non-taxable income. Good record keeping helps you also keep track of deductible expenses. You may forget expenses when you prepare your tax return unless you record them when they occur. And that is what's known as contemporaneous records. So just be mindful that if you wait till tax time to recreate all of your expenses, there's a good chance you're going to miss out on some very, very good deductions. Everybody can pretty much remember all the big things they bought, but then sometimes there's smaller smaller things that could add up if you're not keeping good records. So just be mindful of that. And again, preparing your tax return, you definitely need to, keep good records. These records support the income, expenses, and credits that you report. Generally, these are the same records that you use to monitor your business and prepare your financial statement. You must keep your business records available at all times for inspection by the IRS. If the IRS examines any of your tax returns, you may be asked to explain the items reported. A complete set of records will speed up the examination. On that note, I will give a little bit of my history. I was an auditor or examiner for the bulk of my time with the IRS. I started in 2005 in collections, and then I quickly moved over to examination. So examination of 1040s. I did a little bit of revenue agent work as well. One of the things that prolongs an examination is when you show up with a shoebox full of a trash bag, all kinds. We've seen it all. I mean, not everything. I'm sure there's more things that they can show us, right? But one of the ways to get through an audit expeditiously is to, have good records. Now, with that being said, I've seen some of the prettiest records you ever want to see. They're just there's no substantiation, and so but those go quickly too, because even though they're wrong, they're organized. So we get through the audit pretty quickly either way. So and on that note, I do want to add that when we audit a return, we send out a report that if there's an adjustment, then there may be penalties and interest associated with that. Well, as it relates to interest, when we do the adjustments, the interest is calculated back to when the original return was due, and interest accrues on a daily basis. So it's in your best interest to try to not have adjustments. Now, sometimes it's through no fault of your own. Sometimes there are situations where you rely on a preparer that either doesn't know what they're doing or are not on the up and up. And I see we have a question. Go right ahead.
This is actually on Zoom from Mary Perkins.
Okay.
Is there a concise resource for tax deductible allowances, especially for Schedule C small businesses?
A concise what?
Resource.
So, great question. And as we go through this presentation today, there are a number of publications that talks about, starting your business, keeping good records, a number of things. All of these publications are found on irs.gov. So I'm an advocate of irs.gov, because even in my job, we have, in my previous positions, we are kind of governed by the Internal Revenue Code and other areas of tax law. The way I look at it, irs.gov puts some of this nomenclature in the tax law into layman's terms, so I can go in there, whether it's for myself or to explain it to the taxpayer. Now, the IRS, the Internal Revenue Code is the Internal Revenue Code. irs.gov, you can't use it as law, but you can. I always say it's the law in English. So, but to answer the question, the publications that I'll mention later on, they're the greatest of resources for information that you're seeking, especially for the Schedule C.
It's still 7 years.
Is that the max you guys will go back on an audit? Okay.
I'm sorry.
So there is no limit when you don't file a return. So it's indefinite when there's no return file, as long as, we somehow can come up, because the burden of proof of expenses is on the taxpayer, the burden of proof of income typically is on the government. So if generally 3 years from the date you file a return, the IRS has that statute of limitations to examine the return. There are extenuating circumstances. We'll get into that later. But there are extenuating circumstances, but generally it's 3 years from the date you file the return.
Just wondering how long I have to keep my good records.
Oh, yeah. Well,
I have boxes
So-
and boxes
right, so-
and
it depends on what
boxes.
it depends on what the records are. If, for example, if you have a rental property that is, covers depreciation, you may have to keep those records longer until you dispose of the property, because the useful life of a rental property is 27 and a half years. So as it pertains to the depreciation aspect, you may have to keep those records longer. HUD-1 statements, proof of capital improvements, things of that nature. So, but generally, 3 years from the date you file a return is how long you need to keep those records. And you can definitely discard it. Now, there's always an exception. If you file a claim for refund or amended return or something like that, that might, there's always some sort of exception. But generally,
you'll come knocking on my door for 3 years
right.
of documentation, not 10, unless we're talking
Never,
rentals.
right?
Or some
Unless
of
you
the
didn't
odd
file.
stuff.
If you didn't file,
Yeah, no,
then- right?
yeah.
That's the only.
That's on you
Yeah,
if you
right,
didn't
right,
file.
right. So yeah, great question so far. Where was I? Okay, so we want to, you want to support the items reported on your tax return, like we talked about depreciation, things of that nature. You must keep business records available at all times for inspection by the IRS. If the IRS examines any of your tax returns, you may be asked to explain the items reported. A complete set of records will speed up the examination, and we did talk about that. You may choose any record-keeping system suited to your business that clearly shows your income and expenses, except in a few cases, the law does not require any special kind of records. However, the business you are in affects the type of records you need to keep for federal tax purposes. Your record-keeping system should also include a summary of business transactions. This summary is ordinarily made in your business books, for example, accounting journals and ledgers. Your books must show your gross income as well as your deductions and credits. For most small businesses, the business checkbook is the main source for entries in the business books. So could be the business checkbook, it could be the debit card, the bank statements, things of that nature. So again, it depends on how you operate your business. How you can keep the records any kind of way you want. It's just that when if they need to be explained, you need to have contemporaneous records. You need to have them organized. I don't want to tell you of all of our inner conversations as auditors, but we always would say to each other, "Hey, look, I'm not your bookkeeper, okay?" So that is your responsibility to keep good records. Now, I'm not saying that we would necessarily disallow items that were not when adequate records weren't kept. We sometimes depends on how we're feeling. We'll go in and try to organize some things if we can. But when the frustration level hits a certain level, we start disallowing things, and that's within our rights, because adequate records is a reason to disallow an item. So you have to be able to show like how we're supposed to determine if something is business or personal in nature. So that's on you. That's your responsibility. So as it pertains to expenses specifically. So Um, keep good records, keep good records, and it speeds the process up. Nobody wants to be in an audit a long time. So the main thing is, um, you know, always be in contact with the person who contacted you. If something, because what we send out is called an information document request. So if that we call it an IDR. If that IDR is not clear to you, be in constant communication with the examiner. Let them explain to you what they're looking for, and that also helps. So sometimes your records are nice and tidy, but what they're asking for, you may not even have. And that's okay, but you can get it. It's where the communication comes in. Um, so we talk about supporting business documents, purchases, sales, payroll, and other transactions. You have in your business will generate supporting documents such as invoices and receipts. Supporting documents include sales slips, paid bills, invoices, receipts, deposit slips, and canceled checks. I was looking, I don't see bank statements, but bank statements is another one. So these documents contain information that you need in your record to record in your book. So it is important that you keep these documents because they support the entries in your books on your tax return. You need to keep them in an orderly fashion and in a safe place. I can't tell you how many. I don't want to start giving y'all stories all day, but so many times I've had audits where the audit kind of went left because the taxpayers' records were burned in a fire or got washed away in a flood. All right, listen, I'm just telling you what they told me, right? right. I don't judge. But storing your records is another component of keeping good records. So make sure they're in a safe, secure spot. The good thing about it is nowadays everything is so electronic that there shouldn't be any excuses for that. But just never know, right? These documents contain information that you need to record in your books. They do support entries in your books and on your tax return. So keep them in an orderly fashion in a safe place. For example, you want to organize them by year and type of income or expense. More detailed information, you want to take note of this, publication 583, Starting a Business and Keeping Records. That's found, you get that right off irs.gov. Just go to the search bar, type in publication 583. Yes.
I have a question online from Larry Michael.
Yes.
Do you have any cloud-based systems that you would recommend for securing business records online?
Oh, I'm not allowed to recommend any sort of, private or, sort of software like that. But make sure that it's secure. I can recommend that. I can recommend that, do your research. And I don't want to go any further than that because I don't want to promote any sort of private entities, resources. So, make sure, and then one of the things when you're looking for something secure, see if they have, what do you call it? Multi-factor authentication, two ways to verify you are who you say you are. So that's one of the big pushes that, with cybersecurity. We have other presentations, things like cybersecurity. A lot of that has to do with the tax pros because, they handle in a multitude of taxpayer data. So we try to present them with as much information that we have to help make sure that they're keeping taxpayer records safe. Last thing you want is your personal identifiable information out there. So I hope that helps. All right. The system you use to record business transactions will be more effective if you follow good record keeping practices. For example, record expenses when they occur and identify the source of the recorded receipts. Generally, it is best to record transactions on a daily basis. Again, we call that contemporaneous records. So your business checkbook is one of the first things that you should do when you start a business is open a business checking account. You should keep your business account separate from your personal checking account. The business checkbook is your basic source of information for recording your business expenses. You should deposit all daily receipts in your business checking account, and you should check your account for errors by reconciling it. So later in this program, we'll talk about reconciling the checking account. Yes.
I have a few questions. Mary Perkins, she is asking, what are some things you would look for to determine if the tax preparer person company is in alignment with the IRS rules?
Well, the first thing, you want to verify that they are, if they have certain credentials like CPA, attorney, enrolled agent, you can go to IRS and verify that information. IRS.gov, sorry, IRS.gov. Interview the person preparing your return. See if they have experience in your line of work and your business type. There is a practitioner database on IRS.gov. Type in the search bar practitioner database, and you can search by zip code actually of practitioners. Now, I think you may be able to kind of ask IRS to find someone who does a certain line, but I don't want to. I shouldn't even say that actually because I don't know. I don't know. But when you interview, you want to interview that individual. Make sure that they know what they're doing, and see what their experience is. Because a lot of tax pros, they will have a niche, and they work on certain types of return. Yeah, they'll take the extras, but that's may not be their cup of tea, so to speak. So, yes.
And then I have one more from Michael Leonard.
Okay.
As a small business owner, we purchase most products from our suppliers' websites or portals. We place orders daily online and do not have any receipts for them. Should we be printing out this info? Can we rely on our suppliers to continue to maintain our order history?
For your account, right? On your bank account.
Or on how you paid, right?
I agree with what they said. No, I mean, it's, yeah.
Yeah.
There's
You're not paying cash. You're paying through some sort of
Right.
digital payment
right.
where there's now a
There's a
receipt,
record.
a record somewhere.
And that's works.
It's 2024. There's a record somewhere.
So would you say statements, if anything else, like just to prove them? And
Well, I'd be a little cautious if they're not giving you invoices and things of that nature. I'd be a little cautious anyway. But about dealing with that individual vendor. But if you have no choice and if you like their services, just make sure that you're doing it online. Again, your records are the transaction itself. As long as it's a business use of this transaction, like if you're at Home Depot or Walmart or some of those purchases could be personal in nature. But even with them, you still know what you're buying. So that receipt has itemized listing of whatever you purchased. However, if you go to a photo supplier, all they sell is photo equipment. Well, I don't know if I can't think of a scenario where you shouldn't get from your vendor,
No.
you know, receipt or invoices for everything that you purchase. So, and I hope that helps. But I mean, bank statement is your if nothing else, you have the bank statement.
So kind of in that vein, and you may be getting to it, Cash App, Venmo, where is the IRS on that now?
Yeah.
Did I jump ahead?
No, it's not on that. No, that's not this lesson. That's not this lesson.
El jueves anterior.
Vague with the rule
Sí.
changes, and then they got delayed, and
The last information that I have was yesterday.
Sí.
I think it's 5,000.
Yeah.
It went from 20,000 to 5,000
Yeah.
in receipts on those
Yeah.
apps. Then you'll get a 1099K. So
Pues no queremos dar el trabajo a ellos, sí.
the last information that I
Gracias,
have,
Maluca,
I think after that it's going to be 600. Well, there you
O
know.
sea, igual no tenemos. Para
Right.
mujer no. Para hombres sí hay.
I will double check.
Pero mándele,
I will
mándele.
double check that and get that information back to paper. And but 5,600. It could.
I
The
knew
main
it was
thing
trying
is
to be interpreted.
keep
and-
your records. If you're doing business on those third-party payment systems, keep your records because it should match. Your records should match what the 1099K says. So
Okay.
you know, that's the main thing.
They said about Art uses Venmo.
I use Venmo and Zelle, and I think the issue is whether you record those payments or receipts into Venmo or Zelle in your books, which I do.
Right. Right.
So I mean, I collect probably more than $5,000 in Venmo or Zelle payments, but
Okay.
it's all recorded, it's all transferred, and in fact, the payments I transfer them from my Zelle and Venmo account into my business checking immediately. So it still shows that transaction in the checking account.
My bigger question is we have employees who we pay through because we have a bunch of kids
Mhm.
and want to be paid through Venmo
Of course.
and Cash App. And at what point do we get to stop sending the 1099 and Venmo will do it for us? That's why I was like, ooh, if it's $600, awesome.
Payroll.
Yeah, but they're all 1099 children that work 10 hours. You know, I say children, I mean, legal working adults, but
I don't judge. No.
only our children
Right.
have to work.
This being recorded.
They are all legally allowed to work, but
So, you know,
I'm actually
Some of
thinking on
this
the
is-
flip side, like where we have to 1099 vendors
Mhm.
because we bought a trailer for $2,000
Right.
through Cash App. Like
Right.
when I would really love for that to stop, so I don't have to do it.
right.
Um,
Let me just
does that
say,
make sense? Kind of where I'm going.
it makes sense though.
Okay.
But it kind of ties in this regard. Only keep your records.
Mhm.
Keep your records because you know if you have to issue a 1099 or 1099K, you'll have your records.
Gotcha.
That's like that's a whole different presentation. I don't know if Venmo is going to send out the 1099K. I'm only telling you, be prepared by keeping good records. That if that helps. So this is kind of an older presentation. It says here, you should make all payments by check to document your business expenses, but that also can include debit cards and all of if you're sending Cash App payments, Venmo payments, just keep your records. Keep your records. And those third party apps is a good record keeping source as well, because you should get a statement from each one of them every month for payments that you made and received. So that's the main thing. Now, when it comes to writing checks payable to yourself, only do that when making withdrawals from your business for personal use. Avoid writing checks payable to cash. If you must write a check for cash to pay a business expense, include the receipt for the cash payment in your records. If you cannot get a receipt for a cash payment, you should make an adequate explanation in your records at the time of the payment. Use the business account for business purposes only. Separate. I think everybody should be aware that business and personal accounts should be separate. Indicate the source of deposits and any and the type of expense in the checkbook. So gross receipts. This is the income that you receive from your business. You should keep supporting documents that show the amounts and the sources of your gross receipts. These documents for gross receipts include the following: cash register tapes, bank deposit slips, receipt books, invoices, credit card charge slips, Form 1099 miscellaneous, and pretty soon Form 1099-K. So just organize that stuff, keep it together, record daily or as often as you receive income. Last thing you want is unreported income, right? Especially when you meant to report it, but you didn't have the record. So, I think this lesson talks about this later on, but, if there's a 25% omission of income, the statute extends from 3 years to 6 years. So, just keeping good records is a way to avoid anything like that. Purchases are the items that you buy and sell to and resell to customers. If you are a manufacturer or producer, this includes the cost of raw materials or parts purchased for manufacture into finished products. Your supporting documents should show the amount paid and the amount was for purchases. The documents for purchases includes canceled checks, cash register, tape receipts, credit card sales slips, as well as invoices. Expenses are the costs that you incur other than purchases to carry on your business. Your supporting documents should show the amount paid and the amount was for a business purpose. Documents for expenses includes, again, canceled checks, cash register tapes, account statements, credit card sales slips, invoices, also petty cash slips for small cash payments. So if you have a petty cash account, you want to have records for that as well. All right, so now we want to talk about travel, transportation, entertainment, and gift expenses. All of this is found on publication 463. Again, you can find this on irs.gov. This before I get into this, I want to say this is one of the most highly examined item on the Schedule C specifically because the burden of proof is a little bit, there's more documentation that you need to show for some of these items. So if you deduct travel, entertainment, or gift expenses, you must be able to prove or substantiate certain elements of these expenses. Again, more information is found for these types of business expenses on publication 463, travel, entertainment, gift, and car expenses. Now there's what's it called? Table 5-1 kind of explains a little bit more in depth about what the elements of substantiation for a good portion of these types of expenses. So when we talk about adequate records, You should keep the proof that you need in an account book, diary, statement of expenses, or similar record. You should also keep documentary evidence that, together with your records, will support each element of an expense. So, as it pertains to documentary evidence, you generally must have documentary evidence such as receipts, canceled checks, or bills to support your expenses. There is an exception, however. So documentary evidence is not needed if any of the following conditions apply. If you have meals or lodging expenses while traveling away from your home, for which you account to your employer under an accountable plan, and you use a per diem allowance method that includes meals and or lodging. Your expense other than lodging is less than $75, or you have transportation expense for which a receipt is not readily available. So one of the things, if we're, for example, if we're examining your return for travel expenses, right? Let's say entertainment. Or travel, it doesn't matter. One of the things that if you're an employee, if your income is employee based, the first thing we're going to ask for is the reimbursement policy for the employer that you work for. Okay, the reimbursement policy is going to let us know that there's an accountable plan and that you're already reimbursed for these expenses. So you know what that means, right? It's getting disallowed. It's getting disallowed because your employer is already reimbursed you for these expenses. So that's double dipping. If the reimbursement, if there is no reimbursement policy, that's the best way to put it. If there is no reimbursement policy, that means these expenses may not be required by the employer. Therefore, it would get disallowed as well in those scenarios. That's if you're an employee, of course. Now, as an employer, the highlight that I want to point out to you is that you need to have a reimbursement policy in place if you're reimbursing your employees for certain expenses. So that's the whole point of it. Yes.
Thank you. Is that something that should be in the employee handbook?
The reimbursement policy is usually found in the employee handbook. Yes. We ask for the reimbursement policy, but typically it's found in the. I should have been more clear on that, but yes, you're absolutely right.
So
Thank you.
I'm an owner. I'm
Yes.
headed to Denver in a couple of weeks for training for catering and events with an association. So any expenses that I have on that trip, I'm going to utilize my business credit card for it,
Right.
and then it'll be tracked. So that in itself will be entertainment, out to dinner with potential clients, or travel expenses and things like that for that trip.
You're on the right path. It's not necessarily all that you need, but it's most of what you need. I think it's what you're talking about is coming up. So, who, what, why, when, and where, that sort of thing. Who's claiming whose expense is it? Is it your expense? Now, I don't want you writing off something somebody else paid for, right? So it's the amount, the date and time, and the location. So when you talk about travel expenses, so that's what you're pretty much talking about. The travel costs, maybe hotel lodging expenses, things of that nature. Not the meals thing. That's again, whatever your reimbursement policy states. Sometimes they'll pay for a certain amount. The main thing is if you're getting reimbursed for it, you're not getting it on your return. But as an employer, you know, the company's paying for it, so it's a deductible item. Yes.
I do have a question on meals. So if you're traveling, like she's talking about, she's in Denver for 3 days or 4 days.
You said meals?
Meals.
Okay.
She's in Denver for 3 days traveling on business, but you got to eat
Right.
anyway.
Right.
And I know the meals thing, it's only 50%,
50%,
right?
yes.
Are all meals still deductible while you're on business, or is that sort of dependent on what you're doing with your meal? Are you meeting with clients or potential clients, or if I just go to McDonald's because I got to eat, is that deductible as well, just by default?
Great question. Rather than answer that question today, though, I would prefer that you go to publication 463, and it should spell out everything that is or is not deductible in that, because I don't want to. Right but no, that's a great pub though. That's a great pub, and it's utilized. If utilized, it could save you some heartache and all of that. So read it before you go on the trip, right? So you'll know, hey, I want to steer away from this or go right. Yeah, there you go. There you go. So, but great question. As a stakeholder liaison, I'm the facilitator, right? I'm trying to point us all in the right direction. So that rather than try to be the expert here, I just want to give you the resources that you can use and look it up for yourself. Also, then when you run into trouble after doing your research, call me and then we'll get our research team involved. So a lot of stuff is pretty straightforward in these pubs. So, you can't go wrong. You just can't by referring to the pubs and IRS.gov. So, adequate evidence, documentary evidence. Yes. We got a long way to go. All right, I'll speed read a little bit here. Okay, so documentary evidence ordinarily will be considered adequate if it shows the amount, date, place, and time, and essential character of the expense. Examples: a hotel receipt is enough to support expenses for business travel if it has all the following information: the name and location of the hotel, the dates you stayed there, separate amounts for lodging, meals, and telephone calls. It helps if you have an itinerary. I want to move fast here, but have an itinerary for the trip, that'll also help. Let's see. Assets. Assets are the property such as machinery and furniture that you own and use in your business. You must keep records to verify certain information about your business assets. You need to record. You need records to compute the annual depreciation and gain or loss when you sell the assets. Documents for assets should show the following information: when and how you acquired the assets, purchase price, cost of any improvements, 179, section 179 deduction taken, deductions taken for depreciation, deductions taken for casualty losses, such as losses resulting from fires or storms, how you use the assets, when and how you dispose of the asset, whether it be you sold it, you transferred it, bartered it, or whatever the case may be, and expenses of the sale. The following documents may show this information: purchases and sales invoice, real estate closing statements, canceled checks, or other documents that identify the payee, the amount, and proof that the payment or electronic funds were transferred. So specific employment tax records, you also must keep records of employment for at least 4 years after the fourth quarter of the year. Additional information on this is found in publication 15, also known as Circular E, the Employer's Guide, publication 225, the Farmer's Tax Guide, and Employment Tax Record Keeping. If you search that on irs.gov, it'll give you a plethora of information as well. Specific records that should be kept for employment taxes are EINs, employee information, including names, addresses, social security numbers, and occupations of the employees and recipients. Any employee copies of Form W-2 that were returned as undeliverable, dates of employment, periods for which employees and recipients were paid while absent due to sickness or injury, and the amount and weekly rate of payments you or your third-party payers made to them, wage, annuity, and pension payments, tips reported, fair market value of in-kind wages paid. Your records should also include copies of employees and recipients' income tax withholding allowances, forms such as W-4, W-4P, W-4S, and W-4V. Dates and amounts of tax deposits made, copies of returns filed, 941s, et cetera, et cetera. Records of allocated tips, records of fringe benefits provided, including substantiation. All right. So this slide supposes to show an example of record keeping system might look like for a small business. Whether you use a system like this or an alternate system, you need to be aware of the burden of proof. We talked about this a lot today. The burden of proof is the responsibility that is yours to prove. Entries for expenses, but it's your responsibility to prove entries, deductions, and statements made on your tax returns, and that is known as the burden of proof. You must be able to substantiate certain elements of expenses and in order to deduct them. Generally, taxpayers meet their burden of proof by having the information and receipts where needed for the expenses. You should keep adequate records to prove your expenses or have sufficient evidence that will support your own statement. You generally must have documentary evidence such as receipts, council checks, or bills to support your expenses. Actual evidence is required. Additional evidence for travel, like we talked about, entertainment, gifts, and auto expenses. I don't mean to suggest that you can't recreate records. I was just making that point to say it's harder when you do it that way. Sometimes there are times like flood, fire, whatever. You may need to go back to, like, for instance, auto records. You may can use the mileage on a service record for the vehicle to prove how many miles you drove. But then now you got to figure out business versus personal. So I just wanted to make that point. The length of time you should keep a document depends on the action, expense, or the event which the document records. Generally, you must keep records that support an item of income, deductions, or credit shown on your tax return until the period of limitations for that tax return runs out. The period of limitations is the period of time in which you can amend your tax return to claim a credit or refund, or the IRS can assess additional tax. The information below reflects the periods of limitations that apply to income tax returns. Unless otherwise stated, the years refer to the period after the return was filed. Returns filed before the due date are treated as filed on the due date. So if you file in March, it's April the 15th on a 1040. Keep copies of your filed tax returns. They help in preparing future tax returns and making computations if you have to file an amended return. The period of limitations that apply to your income taxes, keep records for 3 years generally. So a couple of scenarios down here may not apply to you. That's all it's saying. Keep records for 3 years from the date you filed the original return, or 2 years from the date that you paid the tax, whichever is later. If you file a claim or credit for refund after you file your tax return. Keep records for 7 years. If you file a claim, if you file a claim for a loss from a worthless security or bad debt deduction. Keep records for 6 years if you do not report income that you should report, and it is more than 25% of the gross income shown on the return. That's that 25% omission rule. Keep records indefinitely if you don't file your return, okay? That's not funny. I'm not, it's just, I think I'm a comedian sometimes, forgive me. Keep records, also keep records indefinitely if you file a fraudulent return. Keep employment tax records for at least 4 years after the date that the tax becomes due or is paid, whichever is later. The following questions should be applied to each record as you decide whether to keep a document or throw it away. Generally, keep records relating to property until the period of limitations expires for the year in which you dispose of the property. So it could be 27 and a half years fully, but if you sell it in 10 years, you don't have to keep it after the 10-year part. You must keep these records to figure depreciation, amortization, or depletion deduction, and to figure the gain or loss when you sell or otherwise dispose of the property. If you receive property in a non-taxable exchange, your basis in that property is the same as the basis of the property you gave up, increased by any money that you paid. You must keep the records on the old property as well as on the new property until the period of limitations expires for the year in which you dispose of the property. 1031 exchanges, some of you may be aware of those. So that's, yes. Are we done?
So do you have anything to wrap up?
Yeah, let me just, I only have a few slides left here. So I'll just, electronic records, you know about those. Here's a couple of publications that we already talked about that, may be of use to you. But I'll send out this in a PDF format so you can refer to it. Go to irs.gov, go to irs.gov, go to irs.gov. Some more publications. Irs.gov, use search word record keeping, gives you a plethora of information there. And my name is Paul Sadler. It's been a pleasure. Hopefully we can do this again. This was a lot of fun. So if you have any questions, here's my information. Thank you, Jessica. Thank you to the Charlotte Area Chamber of Commerce. And till next time.
Bye.